Our meeting is being recorded. Good to have an opportunity to talk with everyone here, and happy to answer questions along the way. If you want to just type into the chat, Audrey will pick out questions and offer them up as we're talking. I've been here in Orlando, grew up here since I was 5, I'm 35 now. Had a interesting entrance into the industry, and I was 2 years old when I was introduced to the industry. My dad actually took me to an investment conference. He took the whole family 33 years ago. And so my father started his practice before that, about 4 decades ago. And I joined 15, 16 years ago. Today I have 5 little kids. 9 is the oldest, 1 is the youngest. And really love what I do. And I'm super fortunate and thankful to have had my father start so many years ago and to be able to join and work with him along the way. And today he works far less, a few days a week, and we handle most everything, my staff, my employees, and Hao and I. And I'll let Hao introduce himself as well.
Hi there, everybody. I've been working with Paul Armstrong for the past 5 years. I'm also the first very fortunate one who Paul has been mentoring for the past 5 years. So we're a partner here at Northwestern Mutual. We, on a day-to-day basis, we're meeting like-minded people. We're design planning and help them achieve their goals. That's where our passion is. Glad to be here. We're glad to be answering any questions that you may have. Yeah.
That's great, thank you. So we do have some general topics provided on the PowerPoint slides, but again, if you guys have any questions, please feel free to drop them in the chat and we'll answer them along the way. So first is, what does a financial planner or advisor do?
We do a lot of things. I guess one of the biggest things that we have a goal of is to give our clients, the people that we work with, peace of mind, to give them peace of mind and help them hit their goals. Sometimes people don't know what their goals should be. So we're helping them develop goals of when to retire, when to buy a home, when to buy investment property, how to save for college, anything on that financial spectrum. Those are things that we help our clients with.
Anything to add, Mr. Feng?
I say we're also in a kind of like relationship business. We are the accountability partner to our clients, to our friends' goals and their vision. We help materialize their vision, their goals in the way that we can. And there's one of the saying, sorry, go ahead.
No, go ahead, Hao.
There's one of the saying that, you know, accountability without relationship is just a pure harassment. So yeah, we're in a relationship business.
And I think also the psychology business, there's a lot of emotions around money. There's fear, there's greed. You know, if people are not educated as to, you know, what is possible, what they can do with their money, sometimes they don't invest. Sometimes they leave money in cash, and cash for a long-term perspective, that can be the worst investment. You think about $1 million, what is that worth in 40 years, 50 years, when some of you will be in your 60s? Well, it's worth closer to $200,000 after many, many years of inflation. So the psychology role, the relationship role, as Hal's referring to, That's a lot of what we do in helping our clients understand, why to move forward, why to invest, why to remain invested. Last year, as everyone probably knows, the markets were crazy, up and down, more up than down. If you had sold or gotten out of the market in March of last year, then you would have lost a lot of money. But if you had stayed in, ridden the wave, or if you had bought in March, then you made a lot of money.
It's very interesting. So next, along with this one, we have types of financial planners and advisors.
I think this question can be answered in a lot of ways. What are different types of planners and advisors? Sometimes we see a few different sectors, if you will, or paths. I think one way to think about that is there's an investment advisor, and the investment advisor may discuss an investment account in a vacuum or in a silo, not necessarily accounting for goals or real estate or things that don't fall in the scope of that account that is managed by the advisor. And we think of that as siloed advising, siloed planning. So planning in a vacuum. And one may do very well with a particular investment account, but there might be a lot lacking if you ignore other aspects of planning, like debt, for example. If you have student loans, if you have mortgage debt, if you have credit card debt, other risks like getting sick or injured, or health insurance, life insurance, disability insurance. So another type of planner looks only at insurance, and insurance planning is important. But if you only do insurance planning and don't do offense or investment type of planning, then there's a lot lacking there as well. A third type, and I think more advisors are kind of integrating towards this, is comprehensive planning, and that addresses defense, that's debt reduction and insurance, and offense, that's saving, investing, retirement planning, education planning, and that's integrated planning, comprehensive planning. We believe that doing both defense and offense, looking at the full picture, is the best way to approach your finances.
Well, so Paul mentioned looking at helping clients or friends, looking at the big picture is very imperative for the client to make sound financial decisions. Basically, a lot of the successful people or business owner, doctors that we work with, they are super busy. On a day-to-day basis, they're immersing themselves just with work, but they don't ever step back and look at, a lot of them have real estate portfolio, stock portfolio, other investment portfolio. They are very busy making money or living the life. They don't step back and look at the big picture. What's the whole assets looking in with regard to rate of return in 30 years? What's your net worth in 30 years? What's your net worth in 40 years? What's your net worth when you're reach your age 80? That's gonna involve a lot of taxes. What's the distribution strategies? If we're only looking at investment in a silo, we're only chasing the return. So at the end of the day, you might have to pay a lot of taxes instead of just, we help our client looking at the full picture, big picture, where we're going, how do we minimize the risks along the way. How do we achieve the goal? First and foremost, basically.
Okay, makes sense. Thank you. Next question, we have the path to becoming a financial advisor or working in the finance industry. And since our audience members are high schoolers, middle schoolers, we do have college freshman Tony here. So we just want to know about the college major, degree, internships, or even after college.
Hao and I both have finance degrees. I think that's a good first step in terms of the path to becoming an advisor. It's not a necessity. Advisors that don't originally get a finance degree, but I think that's a good first step. One thing that I think is really important is to do an internship. There's a lot of different places you can do an internship. Plenty of different investment banks. Northwestern Mutual has a great internship program. I was an intern for 4 years. Every year, freshman year of college, sophomore, junior, senior year, every year during the summer, I interned full-time. And I got a real sense of exactly what this career has to offer, exactly what I would be doing on a daily basis. And I think without an internship, becoming a financial advisor may seem appealing, may be enticing or exciting, but without doing an internship, you may have no idea what you're really getting into. So I think, like I said, getting that finance degree is a good first step, but not a necessity. And then going and exploring an internship is really smart.
Yeah.
Okay. And then what are some important or necessary traits to achieve success in this industry?
Well, one of the most important things I think is communication skills, being able to connect with people, to understand them, communicate your ideas, communicate their ideas back to them that they've shared with you. Communication and connection, I think, is probably, those are some of the most important things, because we can be geniuses, savants, we can be incredible at picking the right stocks or creating the right portfolio. But if we can't communicate that to a client, what we have to offer, then we're not going to have any clients. We're not going to have anyone that hires us to manage their money.
Well, for me, you have to have determinations. You have to have grit, meaning you have to be able to deal with failure in this career or in any other career again and again and again. Basically, you have to be able to get back up every time you're being knocked down. Because in this career, you are dealing with or you are facing a lot of rejections. That's just back to the point. The communication skill is very important. You have to be able to communicate or being empathy to, let me just step back a little bit. You have to be able to listen first, being empathetic and listen to your client's problem and being able to understand the problem and deliver what you need to educate on the subject that the client needs to know. And that's important. And there's another thing that is important is also you have to know your purpose, like know your why. Just pretty much like before becoming a financial advisor or wealth management advisor, you, like Paul suggests, go through an internship or try out or go to a local investment bank or any financial firm like Northwestern Mutual. Go ask for a job. Even you have to work for free. It's through along the way that you gain some experience. That's the very best investment of your time, that you know why you want to do this. This is important.
That makes a lot of sense. Thank you for sharing. Next, we have financial advice for high school students, smart spending, saving, or investing.
Hal, you want to take that one?
Well, this is kind of simple. Create a budget. And what we tell often to younger clients or friends is to pay yourself first, save first, create a budget, save first, pay yourself first, and then spend. Basically, you have to save or invest the majority of your income, or spend less, basically. Trying to do it as early as possible. Don't wait.
Yeah, I think that's really good advice is to start to build your habits, even young, of budgeting, of understanding the value of money, not spending everything just because you got an allowance or birthday money, or if you're working, to have spending money. The sooner that you can, as Hal says, pay yourself first, the sooner you start to build that habit of how valuable that is. And I think that leads well into one of the next questions in terms of investing early. If you're 15 years old and you start to invest money into a Roth IRA, and Audrey, I'm skipping to the next question.
Yeah, sure.
But if you're 15 years old and you start to contribute to a Roth IRA at $500 per month, and plenty of people have probably heard this before, but in 40 years, when you're 65, it's highly probable that you'll have over $1 million, $500 a month. And what's the math on that? $6,000, $500 a month, 40 years. So that's about $240,000 will likely become more than $1 million. And that's at just a 6% rate of return. And the broad market indexes on the last 40 years have earned between 8 and 12%. So very, very achievable. The sooner you start saving, the more powerful compound interest can become.
So on the topic of that, I did have a question. So is there a catch for the Roth IRA? Like, it just sounds too good to be true.
You have to have earned income to contribute. So reportable income. Is there a catch to the Roth IRA? Roth IRA is it's not always feasible that you can contribute forever because there's limits to your income. So, at a certain amount of income, you cannot contribute. The federal government says you make too much money, you're not allowed to do this, tax efficient contribution. And that income limit goes up a little bit every year. What is it now? About 140,000, I think, as a single person. So if you make over 140, you're not allowed to contribute. But there might be some time, before that you can contribute. You make 140,000 or less. Another great benefit of the Roth IRA is that unlike some retirement accounts, most retirement accounts, when you put money in, you really don't want to touch it because there's a penalty to access the money before age 59 and a half. So that's a traditional IRA or a 401k, other types of retirement accounts. You really don't want to touch because there's a penalty. And with a Roth IRA, you can actually withdraw before age 59 and a half without a penalty. You can withdraw your contributions. So if you put in $100,000, if that account may have grown to 200, you can't take the whole 200 without a penalty, but you can take your contributions, your 100,000 out before that age 59 and a half. It may not be a good idea to do it, but if you need it, you can do that without a penalty. So is there a drawback or a catch to the Roth? I don't think so. I think it's a great vehicle to start saving into.
Okay. I'll add something to it. So a lot of people are saying, or there's some like misconception about investing in the market or Roth IRA in general. People are talking about there's a great deal of volatility that's been going on or has been going on. People are talking about S&P, his all-time high. How far is it gonna go? We don't know. But look at the past history for the past 30 years. Look at what happened in 2007 when real estate bubble. It probably are most of you guys are still young, or really young. At that point in time, a lot of people are afraid of a market crash, and market hit all-time high back in 2007. It did happen. But look at where it happened, like after 11 years. If you're young, you can endure the volatility, or you can ignore the volatility because your investment time frame is so long, right? I've been telling people, or friends, an interesting fact. Had my mom invested $10,000 the day when I was born. I'm 37 years old. The $10,000 had my mom invested in S&P 500 37 years ago, the day when I was born, I would have had $546,000 just for that $10,000. So basically, if your investment time frame is long and you can, if you're young, you can ignore a lot of the volatility. Don't be afraid of the market. Yeah.
I think that's something else to dig in on too, and just some of the things that we see with different age groups that we work with. And Hao and I tend to work more often with people over 40. My market particularly is a lot of times over 60, and Hao a few minutes ago referred to the distribution phase or the withdrawal phase. How do you take money out of all of your accounts efficiently? In those phases over 60, we find that people have invested for a lot of times for a long time. So they've seen markets go up and down, and they've seen the value of remaining invested, not trying to time the market, not trying to pull out when it seems high or buy in when it seems low, but remaining invested. And something different when we work with younger people, sometimes in their 30s or younger than that even. People in their 30s were graduating college right around the time of the financial crisis, 2007, 8, 2009. And a lot of people in their 30s, we do find that it's more difficult for them to understand not timing the market, remaining invested. They're more apt to want to control things. They're more concerned about market fluctuations. When they graduated college, it was tough to find a job for a few years. So it's an interesting difference with the different age groups that we work with. And what's more interesting is those people that are 30, 35, even 40, they don't need their money right away usually. They need their money in 15 or 20 years. So there's more leeway, if you will. There's more license for their accounts to fluctuate, but they don't realize it all the time. And so the sooner that you can understand that markets go up and down, but more up than down, the better off you'll be in starting to get invested and remaining invested.
Okay, so I have a question.
Oh yeah, sure, go ahead.
Okay, so Roth IRA is it? So it's basically a savings account, right?
A Roth IRA?
Yeah,
Generally an investment account. You can own
because
cash and not invest, or you can buy stocks or funds.
because it always increases, like in the long term, it always keeps on increasing. So basically, it's a low risk, isn't it? Low risk, unlike the other stocks.
Not necessarily. So whenever we're talking about the long term always increasing, we're talking about the markets in general. So a Roth IRA, if you own an index fund is kind of like buying the market. The S&P 500, that's the 500 biggest companies in the nation. And when you say buy the index, usually that means buy the S&P 500. And that has earned about 10% on average over the last 40 years, but it has gone up and down a lot. So I wouldn't call it, someone wouldn't necessarily say that it's low risk because it's fluctuated. But when you really look back over 10, 20, 30, 40 years, it's started here and ended much higher.
Yeah, it keeps on increasing every time. All right.
But at the same time, $100,000 in March of last year would have dropped to 65,000 in that S&P 500. But at the end of the year, it would have been 118,000. The S&P earned about 18% last year. So it's not necessarily what you call low risk, but it tends to always rebound.
So you recommend starting as early as possible, am I right?
Yeah. Yep.
Okay.
And a Roth IRA is a vehicle, it's an investment vehicle. It's pretty much like a saving account, checking account. Roth IRA is one type of investment account. Really depends on what type of investment that you're putting into the account.
Yeah.
What I mentioned earlier, that as a guy as young as you are, you can afford, because your investment time frame is relatively long. And if you're starting a Roth IRA, just mentally, you have the option to access your money before 59 and a half, but just mentally block that. You don't ever use the money before 59 and a half. Just keep investing, keep saving, keep buying equity into that account. You can afford volatility, you can afford risk. Just pretty much like what I said, I had my mom invested $10,000 back in the day I was born. I was referring to S&P 500. The rate of return for the past 37 years, compounded with dividend reinvested, is 11.23%. If you're thinking time the market or even selling the equity and buying the bond, that doesn't usually work. You don't have to do that. Keep it simple. Invest 100% into equity, some type of index fund at your age. Start as early as possible. You get the result in general.
Okay, interesting. So along with kind of starting early, what are some other first steps that we can take maybe after getting a job or as a teen or young adult, like people say, to build credit and all those things?
Yeah, simple first steps are, just as you're saying, get a credit card, get a phone bill. That builds credit. Start to use your credit card and pay it off. As Hao mentioned before, pay yourself first. Start to budget. Start to save before you spend. The sooner that you can build the habit of saving, building credit, having some debt. Not all debt is bad debt. Some debt is good debt. The further along you'll be to kind of establishing a position in your financial life.
Okay.
I really don't have anything to add except just getting some internship, getting some job, and trying to be independent, or trying to budget your finances yourself. I know a lot of the high schooler or even college students are still living with parents, don't have to worry about expenses, etc. But try to be financially independent as soon as possible, as early as possible. You don't necessarily have to not relying on your parents, but just developing a habit of budgeting yourself is a good start.
Okay, I see. And we did have a question about, does a debit card work as well?
For building credit? No. It is good to get a debit card and open a bank account, but that's not going to help you build credit.
Okay. Then next we have, when should one look into getting a financial advisor?
I think that the answer is different for a lot of people. So some people are concerned about investing and losing money. Some people invest right away. And so I think that answer is different for a lot of people. One of the first things that's important after you have a job, after you have consistent income, is to start to build a cash reserve or an emergency fund. And there's different schools of thoughts. How much do you need for an emergency fund? I think your job stability, your income stability, whether it's sales or straight salary, those are all related factors. But a good equalizer can be 9 months of spending. So if you spend $5,000 a month, saving up $45,000 is a good place to start in terms of having an emergency fund, a cash reserve. I think after you build up an appropriate emergency fund is when you want to start looking for an advisor, looking for a planner.
Well,
yeah, sorry.
No problem. Well, there's with nowadays people are getting information from social media, like you mentioned, as advertised on social media. Like people are getting different information from different venues. It's always, good to have some credit information from a financial institution. Right? It does not necessarily mean that you need or don't need the service, but at least you're in the knowing. You know what's possible, what's the possibility, what are the options. To me, that's very important to know your options, to know the pathways. As a young adult or teenager, that's important. So to get a financial advisor, to just talk to some financial professional to get some ideas, to get educated on the subject that you're interested in, or get educated on some subject that matter to you, you might not be aware of. That's important.
Okay, thank you. Next we have, what is your day-to-day life like? Maybe like busiest days to like least busy days.
Well, I'll go first. Nowadays, almost all my days are really, really busy. I have to fight to get some free time, and it's my own schedule, so I make it. So it's self-imposed, and sometimes I'll think back to last year for a little bit. In February and March, the markets were falling a lot. April, just a lot of concerns still about the markets. I remember when we had planned a vacation. We didn't cancel it. It was March 13th, right when things were starting to get really concerning in the pandemic. And I was with my family, and the markets were going crazy. Up 5%, up 10%, down 5%, down 10%. That almost never happens in a day, but it was happening back in March of last year. And I was with my family, and you know, if I got a call from a client, I did have to take it, but or if there was an email, but I tried to remain, you know, focused with my family. I have a staff of employees of 4 people that, you know, they did a fine job taking calls and managing without me for a little while. But when I got back, it was probably more than I've worked in a week, in any other week over the last 10 years. When I got back, I was in the office at 6 a.m. and I don't think I left for that week until 9 or 10 o'clock. That's not normal, but that's what was necessary for that week. That was one of the biggest weeks of the market had dropped in decades. And with a lot of the people that I work with that are a year away from retirement, or 2 or 3 or 4, 5 years from retirement, or just retired, or retired in the last 2, 3, 4, 5 years, you can imagine, you know, they don't usually take the long view when the markets are falling. They're thinking, I have $5 million and now it's worth, you know, 4 million or 4.5, and I've lost so much money. And the reality is, unless they sold, they didn't lose anything. And most of our clients, all but 2 actually, listened to us and did not sell at that time. And at the end of the year, they made up all those losses or drops, and then they made some money. 2 of our clients wanted to sell everything, and they only sold a little bit. So there can be times where it's very demanding, and if you don't, you know, reach out to your client proactively before they call you, if they call you, then you lost. So if you don't reach out proactively, then you might lose that client. They might move their money somewhere else. And if you don't reassure them that their account is diversified, that markets do come back, that this is really not a time to sell, it's a time to actually buy. If you don't do that, then you can lose that client, and they could make choices that really change their whole life. If our clients had sold after losing, or the market's being down 10, 20, 30, 40%, and you know, they have $2 million spending 10 grand a month, and they're in retirement, and that goes down to 1.3 or 1.4, and they sell, they may not be able to have the same lifestyle that they plan to. So it is very powerful to be able to stand up and tell them and give them advice. And it's not easy, and it wasn't at that time. And if I had not given that much energy and attention, then a lot of people's lives literally would be different. They would not be able to spend like they used to. They would not be able to take trips and those kind of things. And so I take it as a personal, you know, it is, they hired us for a reason. The reason they hired us is to make sure they don't run out of money. That's one of the biggest ones. And to give them the right advice. And so it's really important. And that's why I did that. I have 5 little kids, and you know, I just spent some time with them, and they didn't see me much that week. The rest of the year was not as crazy as 6 a.m. to 10 p.m. You know, 12, 14, 15, 16-hour days. But the rest of the year was busy too. You know, the months right after that, April, May, June, July, super busy. You know, getting in 7 or 8 to the office and not leaving till 7 a lot of times. Now that was one of the craziest years. And so in that day, I might have 15, 30-minute calls scheduled. And sometimes, you know, the client keeps the meeting, sometimes they don't. And so a lot of times I would just hope that someone canceled. So I'd get a little bit of free time to go grab something to eat and check on another, talk to my staff about making trades. If everyone kept, and some of those days happen where it was, you know, 29 minutes with one client, and then at minute 31, I needed to be off that call and talking to the next person. So there were some days where it was just back to back to back to back. An average day, I would say we talk to between 4 and 8 people that we manage money for, or that we're talking about moving their account to become their manager. And so on any given day, half the people that I talk with are already my client, and maybe half, they may become my client, or they may say, no, I'm all set. I'm going to keep doing it on my own, or I'm going to keep my other person. And then when I'm not, in a meeting, on a Zoom call, in a meeting in person, haven't had many in-person meetings lately. But when we're not in meetings, then we're working with our staff to actually execute trades, to do planning, projections, and do software analysis to help our clients understand how much they can spend, all of the behind the scenes work that goes into giving good advice. I'll let Hal take over.
It's really different. But Paul's not joking when he said he was just extremely busy. So when I first started, I don't know if have you guys watched the movie Pursuit of Happiness? Audrey, have you watched that movie? Will Smith?
Actually, I have not, but it's been on my list.
Okay. So one of the movie scenes was like Will Smith want to become a stockbroker, and then he got internship. And then the first day he got the internship, he was being handed a phone book. His superior asked him to dial the phone book and talk to the people that he doesn't know, cold calling people, and try to get the people who he doesn't know become a client, trying to sell some, stocks or funds or whatever. So that's exactly what I was doing when I first started, but I don't do it anymore. So my day-to-day is just really involving servicing the client, or focusing on servicing the client that I already have. We call them stakeholders. If we're managing everything that you have financially, or have the financial plan, we're help the clients or friends achieving their financial goals, managing a lot of the assets. We are one of the most important business partner, quote unquote, business partner in their life, right? If our time is not focusing on those stakeholder or clients, then to my standard, in my humble opinion, we're not doing our job. As you get older, tenure in the business, your direction or your way of doing business become different. But I'm just chiming something else. It doesn't matter what kind of career that you want to have in the future, to find a mentor, a good mentor that really invested in you or willing to help you and capable to help you is very important. So when I first started, Paul would put a block some time on his schedule, very super busy schedule, and just help me go through some case studies. I don't, unlike any other people, I don't learn by just, I have to know the bells and whistles, or I have to know a lot of stuff before I have the confidence to talk with, for instance, you're the client. I have to know about a lot of stuff. So, yeah.
Sorry, my internet cut out there for a second, but thank you both so much for sharing. And along with that, we do have a question in the chat that Tony mentioned bonds are risk-free. So could you please explain to the kids what is the best portfolio when they invest $500 every month?
So I'm sorry, could you repeat the part about risk-free?
Yeah, one of the audience members mentioned that bonds are risk-free.
Okay, oh, I see.
Yeah.
Bonds have less risk than equities or stocks. Stocks fluctuate a lot more and bonds fluctuate a lot less. That's very true. But there are plenty of bonds that have a fair amount of risk. There are AA and AAA bonds. Those are the top rated bonds, and they have the highest credit risk. So a bond from Microsoft, for example, phenomenal financials, great company, that's going to be a very high grade, investment grade bond, very low risk. There's also high risk bonds. There are low investment grade bonds. So that's going to be B, triple B, or not even rated. And those kind of bonds can default. The company can go under and you don't get your principal back. Or if interest rates rise or fall, then the value of that bond can fluctuate just as much as the equity markets. But it's a very true statement to say that bonds are less risky generally than stocks. Any security, a bond is a security, a stock is a security. Any security has some risk though. So I wouldn't say they're risk-free. The best portfolio to invest $500 a month. If you're investing in a Roth, or if you're investing for a long time horizon, and you understand that the account can go up and down, and might go up and down a fair amount, then you should own equities, not bonds. And over a long period of time, equities are going to earn a lot more than bonds. The impact of just a 1 or 2% difference in terms of return over a long period of time is huge, really big. Bonds, safe bonds today, we should expect to earn somewhere in the neighborhood of 2 to 4%. And that's better than the bank. The bank doesn't earn much at all. But compared to stocks or equities that we should earn 6 to 10, maybe even more %, that difference in compound interest is huge. So what kind of portfolio should you own for a long-term investment, type of platform is going to be mostly stocks or equities. And the easiest way to own equities is to buy a fund, a mutual fund or an ETF. And that way you don't have to make a good choice. You don't have to be a stock picker and buy the right company. If you had bought Tesla a year ago, then you would feel like a hero. Tesla value went way up and it's gone down some recently, but you would have earned a lot of money. But not everyone can pick the right stock. And so if you buy a S&P 500 ETF, that might be the safest and simplest way to invest $500 a month. And I'm going to share my screen, Audrey, for a quick second. And I'll show the impact of $500 a month in different return rates real quick. It's not letting me share, Audrey.
I enabled it for everyone.
This table shows saving $500 a month for 40 years at a 5.5%, 6.5%, and 7.5% return. And so let's look at year 40, the green and the orange and the blue. So that $500 a month, became a lot more. At 5.5%, it became $870,000. At 6.5%, it became 1.1 million, and at 7.5%, 1.4. So notice the difference between 7.5 and 5.5 is, that's almost $600,000, a little over $600,000 difference So that's why for long-term investments, owning bonds and earning less than equities or stocks, yes, it will not, the account will not move up and down very much. You won't have much risk, but you will be giving up a lot of money in terms of long-term returns. Is that helpful?
Yes, definitely. We did have some more questions in the chat. Sorry. Okay. How much money does a financial advisor make?
A lot of different types of advisors and different roles. And so some advisors are salaried, and a salaried advisor can earn in a pretty wide gambit. I would say anywhere from 70, maybe 150, 200,000 on a salary basis. I think more often than not, an advisor is getting a fee from investment accounts. And so that advisor, their earning potential is going to depend on how much they manage. If you manage $100 million and you charge a 1% fee, it's pretty simple math. That's about $1 million of revenue. And then that person will have, like we do, we have staff, we have expenses, we have payroll, we have rent. And so if we have $1 million of revenue, then generally about 30% of that goes to expenses. So we run a business, so we pay for rent, we pay for our computers, we pay for everything that goes along with the business, our payroll. So that's a broad question, and it depends on how much money you manage, how long you've been doing it. Usually, it has a big thing to do with it, because the longer you manage money, the more you're going to manage. Some advisors, make very little because they, have just started out, and some advisors make $2, $3, $4, $5, $6 million, and some more than that.
Also depends on how hard you're working. There are a couple more questions I'll answer. So one of the questions being, what's the capacity for us? How many clients can we manage? For us, it's not about how we're not chasing for the most client. We're looking for people that share the same fundamental core values. I recently talked to some of my friends or clients. We are looking for 3 types of people. First and foremost is the people that we care, regardless the account size, regardless how much money they're making, they will be the client. The second type of people is people who share the same growth mindset, who fit into our future. The third type of people is people who has money, who has capacity that we can actually help. As a matter of fact, it's not that we're looking for rich people or wealthy people, but those type of people that we can really provide the most amount of service. That's just the reality. And we're not looking to have a huge practice. We're not looking to have a huge practice, because essentially time is the most important currency in our life, right? Paul have 5 kids, barely have any time to spend with them. I have my own life. I have 2 kids. Yeah, there's a work and life balance. So to speak, we only want to work with the people that we like, basically, not chasing for the sheer number.
That's a great answer. Thank you. And next we have from Jamin, with millions of evictions about to take place soon, are you worried about the stock market crashing again like in 2007? And if that's a concern, how should the average person try and survive a crash? And then also we do have a reply from Tony that says, I don't think it'll be that bad. It was because of the Lehman Brothers and other banks leveraging too much. So if you guys could speak on that.
Sure, I think Jay's right there. There's a lot of different controls in place that weren't there in 2007 with regard to leverage. A lot of today, the main institutions, Goldman Sachs and quite a few others, have given out their expectations for the market, year of 2021, to be 10% or more growth. So we really don't think that a crash is right around the corner. We don't know. We never know what's going to happen tomorrow in the market, but we don't expect that. If the market did crash, then it would not be something that we would think we could time. We probably can't assume that's going to happen and sell and go to cash and then get back in at the right time. It's very difficult. You have to sell and buy at the right time. What happens a lot is someone will sell and the market may go down some, and then it goes up, and then they miss the uptick. So when they buy back in, the market's already corrected, and they've missed some opportunity on the upside. So we don't think the market's going down tomorrow or this year precipitously, but the market always fluctuates. It always fluctuates.
Well, there's another side of the story is, although millions of people are being evicted, it's just, I'm not bashing for the government or the function of government capacity or ability to distribute tax dollar or stimulus dollars, but since 2020, the beginning of 2020 until last month, the total savings of the United States has gone up to $1.8 trillion. So there's significant amount of money still sitting on the sidelines. Again, that's just one sector or one perspective of things in general. We stick to our process. Each and every client has different plans, different investment horizon, or different risk tolerance. We just, if the investment time frame, if the investment goal or the goal of the client has not changed, or the investment objective has not changed, usually we stick to the plan that works out in the long run. And there's one other question about a Roth IRA.
Oh, did Mr. Feng just leave the call? Well, we are. I'm sorry.
I don't think he meant to, but something happened with his internet. Kids can contribute to Roths, but they do have to have earned income. They do have to earn income.
Okay. And we are hitting the 6 o'clock mark, but we do have a couple more questions. So, Mr. Armstrong, would you mind staying just for a couple more minutes?
I'm now getting texts from my wife saying, "Come home, help with the kids." I'll take one more.
Sorry about that. Maybe if Mr. Feng would rejoin. But that can conclude our webinar for today. We do understand that you have a very busy schedule, and thank you so much for coming here today and sharing all of your advice and experiences with us. And I definitely learned a lot, and everything was really interesting to me. Yeah, so with that, have a great rest of your day, everyone. Thank you for being here. And thank you, Mr. Armstrong, again.
Thank you. You're welcome. Bye-bye.
Thank you.